Hey everyone, and welcome. Today, we're going to build something absolutely essential, an investor's compass. It's a guide to help you navigate what can feel like a super confusing world of market analysis. So let's jump right in.
And let's start with a really direct question. Are you investing, or are you just gambling? I mean, it's a serious thought, right? Without a clear process, that line between an informed decision and just a plain old bet can get, well, incredibly blurry. Our goal today is to help you build that process.
So, here's our roadmap for today. First, we're going to define what investing really is. Then we'll look at the two main paths you can take. After that, we'll open up the analyst's toolkit, the fun stuff. We'll cover the one golden rule you absolutely cannot break. And finally, we'll talk about the biggest obstacle you're going to face, your own brain.
All right, let's get started with the most basic question of all. What actually separates a true investor from pretty much everyone else who's just playing around in the market?
You know, if you look at the definition, the key phrase here is thorough analysis. Investing isn't about chasing hot tips you heard from a friend or trying to make a quick flip. No, it's a disciplined process. It's about really understanding an asset's potential to grow in value over the long haul.
This table really breaks it down perfectly. Just look at the time horizon. Investors are thinking in years. Traders, they might be thinking in minutes or even seconds. An investor is digging deep, trying to find a company's real intrinsic value. A speculator, on the other hand, might just be betting on which way the market sentiment is going to swing. It's the same market, sure, but believe me, they are playing completely different games.
Okay, so you've decided I want to be an investor. Great! Now you've got your first big choice to make. What kind of investor do you want to be?
So there are two main schools of thought here. You can think of it like this. Active investing is like trying to be the fastest car to win the race. Passive investing is like deciding to just move along with the entire racetrack itself. Active investors, they're the stock pickers. They do all this deep research to try and beat the market and generate what's called alpha. Passive investors, they take a different approach. They simply buy the whole market through something like an index fund, aiming to just match its performance and capture what's known as beta.
So, whether you're trying to beat the market or just match it, you need the right tools for the job. So let's open up the professional's toolkit and check out the 4 main ways to analyze an investment.
First up, we've got technical analysis. You can think of this as being a chart detective. Seriously, technical analysts believe that everything you could possibly need to know is already baked right into a stock's price chart. They study patterns in price and volume to predict where it might be headed next. They're focused purely on market action, not the company's story.
But if you want to understand the why behind that price, that's when you turn to fundamental analysis. This is all about being a business detective. These analysts, they basically ignore the daily blips on the screen. Instead, they dig into a company's actual health. We're talking finances, management, its competitive edge, to figure out what the company is truly worth. The goal is simple, really. Buy a great business for less than its fair price.
Then we have quantitative analysis, which is the world of the quants. These folks use super powerful computers and really complex math to find hidden patterns in just massive amounts of data. It's an incredibly systematic approach, and it's all designed to do one thing: remove messy human emotion from the equation and make decisions based on pure, objective numbers and statistical probabilities.
And finally, we have behavioral analysis. And honestly, this might be the glue that holds all the others together. It recognizes a simple truth. Markets are made up of people, and people aren't always rational, are we? This is about understanding our psychological biases, things like fear and greed, that cause all of us to make predictable mistakes. And for those who can stay calm, those mistakes can create huge opportunities.
What's really cool about the fundamental approach is how structured it is. It's a top-down investigation. An analyst starts with the big picture, the overall economy. How's GDP, inflation? Then they zoom into a specific industry. And only then, after all that, do they dive deep into one single company. It's such a powerful way to build context from the outside in.
So you've got the tools, but using them correctly is absolutely crucial. Every single analyst must understand the very fine, very bright line between doing brilliant research and, well, breaking the law.
And here is that golden rule. Using what's called material, non-public information, like, say, knowing about a huge merger before it's announced, that is illegal insider trading, full stop. What skilled analysts do is something called mosaic analysis, and it's exactly what it sounds like. They piece together tons of little public bits of information to create a unique picture, a mosaic that gives them an edge. It's skill, not cheating. Let's make this crystal clear. If a company's CFO tells you what next quarter's earnings are going to be before they're announced, yeah, that's illegal. You can't use that. But what if you talk to one of that company's suppliers, and they just happen to mention that their order volumes are way, way up? Now that is a perfectly legal piece of your mosaic. See the difference? You're just connecting publicly available dots, not getting secret answers handed to you. Okay, we have covered the tools, and we have covered the rules. But now we have to face the final boss of investing, the single greatest threat to your success. And that threat? It's your own brain.
This quote, this gets right to the heart of behavioral finance. See, markets aren't these perfectly efficient machines. They're wild, emotional arenas driven by powerful human feelings. Our collective fear and our collective greed are constantly pushing prices away from their true value, and that creates both massive risk and massive opportunity.
This is a huge one, loss aversion. All the studies show that the psychological pain of losing $100 is about twice as powerful as the pleasure you get from gaining $100. This bias makes investors do totally irrational things, like holding on to a losing stock for way too long, just because they can't stand the pain of admitting they made a mistake.
And then you've got this one, herding. It's our natural, deep-seated instinct to just follow the crowd. In markets, this is incredibly dangerous. It's exactly what inflates bubbles on the way up and what causes terrifying crashes on the way down as everybody panics and rushes for the same tiny exit all at once.
So let's bring it all home. Let's recap. We've learned that real investing is a long-term, analysis-driven game. You can choose to be an active player trying to beat the market or a passive one just moving with it. We've seen that you have a powerful toolkit with 4 different lenses, but you have to use it legally by building a mosaic, not by using illegal insider info. And maybe most importantly, you have to learn to master your own psychology because your own biases can be your single biggest risk.
And there you have it. We've laid out the map and we've handed you the compass. The world of market analysis, it's a vast place with countless paths to explore. So the only question left is, where will you begin?